We're speaking with Leo Haviland on the first day of May 2014. Leo, we've just seen some stock market highs toward the end of April 2014. Dow Jones, S&P 500, highs for the year being experienced right now. Tell us what's going on in the equities marketplace here in the U.S.
One key point, Scott, has been that earnings have reached record levels on an after-tax basis. They're at least 2, 3, or 4 percentage points above normal. Second, we have to thank our beloved Federal Reserve for its long-standing efforts of yield repression, keeping federal funds less than 0.25% for almost 6 years now. Second, their gargantuan money printing process, which has added a great wave of liquidity into stock and other marketplaces. And that has, of course, the yield repression in particular, has encouraged a hunt for yield. And part of that hunt for yield has been persons rushing into U.S. equities to improve their returns in the hopes that the stock marketplace, of course, will keep rising.
And what are the prospects for that? What's your general outlook on U.S. equities now in the second quarter of 2014?
On balance, bearish, Scott. The reasons to focus on are, first, the other times when the Federal Reserve is engaged in tapering programs, when they've quit their massive money buying processes, the stock marketplace has fallen fairly significantly. That happened in 2010, it happened in 2011, and so they've been tapering in 2014, so why wouldn't that happen again? Second, one should not overlook the massive United States debt problem. In terms of the credit marketplace debt, Scott, we've had very little improvement when you look at the government, households, and the rest of the economy combined relative to the enormous debt that existed in 2009.
Leo, let's talk about marketplaces outside the U.S., Europe, Japan, emerging markets.
Well, Europe has danced in its stock marketplace the dance of the United States, following it directly up. So should United States equities decline, Europe should as well, particularly given that European growth has been more sluggish than that of the United States. Emerging marketplaces have tended to have their market turns around the time of America's, but they have been collectively in a bear trend since the spring of 2011, making lower and lower highs. So take the Chinese marketplace, for example. That, although not moribund, has gone a long way down from its peaks. As for Japan, they've engaged especially since December 2012, in another massive round of money printing on their side, which has propelled their stock marketplace up and probably has helped the United States ones to rally. But on balance, I see Japan declining alongside that of the United States, should the United States tapering help to bring U.S. stocks down.
Okay, we're talking about marketplaces, so let's turn to the commodities marketplace and find out how that compares to the equity and debt marketplaces that you just mentioned. Talk about commodities for a minute, would you?
Well, you raise an excellent issue, Scott. The overall commodities marketplace, which would include petroleum and many other commodities, has been in a decline since the spring of 2011, just like the emerging stock marketplaces. And some of that relates to the so-called China story, where despite a lot of talk that China is continuing to grow marvelously, the Chinese stock marketplace and many other indicators related to China have indicated some sluggishness and arguably even weakness. Scott, here's a chart which may interest you. It's the broad Goldman Sachs commodity index. It's a good benchmark for commodities in general. Since the spring of 2011, the GSCI has been in a long, slow, sideways to downtrend. The highs get lower and lower and lower. That should be a warning sign to those who are bullish about U.S. stock marketplaces. It also ties into the China story and the weakness we've seen in emerging stock marketplaces, also since the spring of 2011. Another aspect of the commodities marketplace is that it has diverged from the U.S. equity marketplace. And that divergence, given that it also fits the divergence of emerging marketplaces, should be a warning sign to U.S. and European equity marketplace bulls.